This morning, we are privileged to have the management team of Watts again virtually from their headquarters in North Andover, Massachusetts. Watts Water has 33 million shares outstanding, trading around $214 per share. That gives them a $7.1 billion market cap, net cash of $190 million for a $7 billion total enterprise value. So Watts is a leading supplier of plumbing products, which spans both water management, flow control, so think of valves, HVAC, water quality products, and primarily for commercial buildings. Joining us this morning is Chairman, President, and CEO Bob Pagano, who joined the company as CEO in 2014, and Shashank Patel, who joined as CFO in 2018. So it's now my pleasure to turn it over to Bob and Shashank for a brief presentation, and then we will get started with Q&A.
Thanks, Sarah, and good morning, everyone. Watts is a trusted global leader in commercial, residential, and industrial water solutions that go into plumbing, heating, drainage, and water quality applications. Last year, we generated worldwide revenues of over $2 billion. We have many leading brands, and we strive to be a top 3 player in all of our end markets. Our large installed base provides a significant repair and replacement revenue source. There are key market drivers or macro themes we focus on that I'll discuss momentarily. We strive to deliver profitable growth by driving innovation through our new product development process and through our smart and connected strategy. Our smart and connected product offerings are centered around our customers' needs by connecting customers with smart systems, controlling systems for optimal performance, and conserving critical resources by increasing efficiency and safety. We're a strong cash generator. We have a disciplined capital deployment strategy focused on a balanced allocation amongst the company, M&A, and our shareholders. From a performance perspective, you can see the improvements we've made over the last 5 years. Significant margin, EPS, and ROIC growth driven by commercial excellence, R&D investment, and operational excellence by investing in process and automation. From a revenue perspective, approximately 75% of our sales are generated in the Americas, much of that in the US. Our business in Europe represents approximately 20%, and we have an emerging presence in Asia Pacific, the Middle East, and Africa. We estimate that repair and replacement activity approximates 60% of our total sales and the remaining 40% from new construction. Sales into non-residential markets approximate 65%, with the remaining 35% into residential, half related to single family and the other half being multifamily. What this implies is that our products are agnostic to end markets. We sell our products to where the market activity is most robust. Our solutions are centered around the long-term secular growth trends of safety and regulation, water conservation, and energy efficiency. Safety and regulation has been a cornerstone of the Watts business from its inception over 150 years ago. Products like our backflow preventers, temperature and pressure reducing valves, and regulators offer the highest levels of performance in safeguarding water systems. We also offer a wide range of products that address energy efficiency, including condensing boilers and water heaters, electric heat pump solutions, pre-insulated piping, heat metering controls, and manifolds used in heat pump applications. From a water conservation perspective, our specialty drainage systems, recirculating pumps, water collection and reuse systems, and regulators all contribute to water conservation. We believe we have many competitive advantages. First, our vertical integration strategy that keeps production close to the customer and reduces supply chain disruption. Second, we have one of the broadest code-certified product portfolios in the industry. Third, our operational expertise and One Watts performance system that has contributed to 480 basis points of margin expansion over the last 5 years. Fourth, our long-term history that has built a significant installed base to provide a consistent repair and replace revenue stream. Fifth, our investment in R&D and our smart and connected strategy that will differentiate our products and drive future growth. And lastly, our balanced exposure to residential, commercial, and industrial end markets will provide support across the cycles. Over the last 5 years, we have made the digitization of our business a strategic priority. We have reached critical milestones, including achieving our goal of 25% of total sales from smart and connected enabled products. We also recently announced our new intelligent water management solution, Nexa. We've been field testing Nexa for over a year and are excited about its potential to address critical needs within our industry. Nexa uniquely integrates sensing hardware, smart and connected equipment, plumbing and hydronic systems expertise, and cutting-edge software into a powerful offering for our customers in the commercial building space. Nexa provides unprecedented insight into water systems and unlocks significant value in on-site operations and water risk management, while supporting sustainability targets and prioritizing the experience and comfort of the building occupants. We expect to continue to lead the industry in digitally connected product offerings. We are committed to expanding the options building managers, engineers, and end users have with our brands to provide notifications, data analytics, and remote access to manage performance while off-site. We strive to maintain a balanced approach in capital deployment. Our strong cash flow provides the flexibility we need to maintain that approach. On the right portion of the slide is our capital deployment priorities. We want to execute on strategic M&A, reinvest in our business, both in CapEx, new product development, and our smart and connected strategy, pay a competitive dividend, and buy back shares, which at a minimum will offset dilution from employee stock programs. Over the last 5 years, we deployed approximately $930 million in total capital. 60% of that capital went back into the business in the form of capital expenditures and acquisitions. 40% was returned to the shareholders in dividends and share repurchases. Our long-term aspirations for the company include, first, driving organic growth at 1% or more above market through our new product introductions, key account management, and expanding our geographical reach. We have increased R&D spend from 1% of sales 10 years ago to over 3% to grow our new product flywheel. Second, expanding operating margin on average 30 to 50 basis points per year through price, volume, and continuous improvement initiatives within our operations and outside the factory walls. Thirdly, we look to enhance our organic growth through acquisitions. We have been an active acquirer of companies, and most recently with our acquisitions of Bradley, Josam, and Icon. We will continue to prioritize acquisitions as part of our capital deployment strategy, assuming targets meet our strategic and financial requirements. So in summary, we're a recognized leader with worldwide reach in the commercial, residential, and light industrial water space. We have many of the leading brands in the markets we serve. Our products are aligned with several key secular trends that drive our markets and our new product development efforts. Our broad portfolio provides natural end market diversification. We are focused on profitable growth through innovation and a performance culture. We continue to invest in new products, including our smart and connected strategy, and in productivity initiatives to drive our One Watts performance system. We have a strong capital structure that provides flexibility to address our capital allocation priorities. And finally, our business model, which includes a large repair and replacement component, provides a durable revenue base that in turn drives a steady cash flow. So with that, Sarah, I'd be happy to address your questions or those from the audience.
Great, thank you for that overview, Bob. So maybe I'll start where Graco ended. Their management team even mentioned that sometimes Wall Street views it as a cyclical company. 60% of your end markets are really for repair and replacement. Can you walk us through the growth potential near term for that business and how it differs with the new construction market expectations?
Yeah, sure. So as we said earlier, 60% of our business is repair and replacement, and that tends to follow GDP. So, GDP is a great proxy for that. Certainly, GDP is positive in the markets we serve, and I would say that the GDP trends in North America, although slightly down from last year, the projections are, and the same in Europe are positive. And that's, again, with our large install base, we feel pretty good about that. Regarding, the non-repair part of our business, the 40% that's tied to new construction, clearly, what we see in that, it all depends on where we are in each one of those markets. So when you look at the institutional market that we play in, we feel really good about that, as well as the data centers, mega projects, that part of the business. But certainly, where we're expecting softness is on the residential side. We think single family is going to be flattish. We believe multifamily, which has had, several years of, permits being down double digits. We're expecting multifamily to be down double digits for the rest of this year as that begins to come back. And then when you look in the commercial marketplace, institutional, like I said, is going to be positive. And certainly there's some more challenged subverticals of office, retail, warehouses. They're going to be tough markets for us. But on balance, as I said, we have a diversified portfolio. We tend to move where the activity is and develop new products and go after those markets that are growing.
Highlighted the reinvestment in R&D and new products. I know that Watts has achieved its initial goal for smart and connected products. Can you walk through some of the features and products you're offering today, and then perhaps the introduction of Nexa that is in its infancy at this point?
Yeah, so we have a really broad portfolio of smart and connected solutions. It includes things like our backflows, our IntelliStation digital mixing products, leak detection products, boilers, water heaters, heat pump solutions, snow melting, automatic control valves, among many others. So those are big parts of the portfolio. And Nexa is a great asset because each one of those, as we're developing our smart and connected strategy, has individual apps. Well, Nexa begins pulling all that together on one single app. And the great thing about Nexa, it integrates our sensing hardware and our smart and connected equipment, in plumbing and hydronic systems with that cutting edge software. And it's modular. It can be deployed in any commercial application. And our team likes to refer to it as a continuous MRI of your plumbing system, right? It measures flow, it measures temperature, it can see where issues are, and you can monitor it real time. So it's an exciting new venture. Team's really excited, and all the customers that are using it have found benefit in that. So it's a great opportunity for us in the future.
And the other benefit as we look at margin expansion has really been the One Watts Performance System and your continuous improvement. Can you walk through some of the main elements of this programs? And do you have an annual productivity target that you set for the team on an annual basis?
Yeah, so I'll take that one, this is Shank. Good morning. So the One Watts Performance System, actually the focus areas and goals, a lot of it is driven around the safety first culture. But then from business process efficiencies, we want to make sure that we're operationally excellent. So we look at, firstly, locating production where we sell. So we are globally, we make product where we sell it for the most part. And then we're focused on customer service and high on-time performance levels. And then improving working capital and then driving productivity. And you asked about productivity. We don't discuss annual productivity goals, but it is significant. And that productivity comes from, sourcing of material, from driving automation in the factories, from driving automation outside the factory. So in transaction processing, as well as the VAV work we do. So that's all tied up in the One Watts Performance System and our annual productivity goals.
Yeah, and just to add to that, look at our One Watts Performance System is a set of tools and processes that really allow us, everybody to leverage one common set of tools, right? So it's everything from, how do you do M&A? How do you integrate? It's a playbook. It looks at how you enter new geographic markets. So it's one way that our entire organization uses to analyze things. So whether it be lean, whether it be 80/20, et cetera. So all of those processes are in this toolbox, and it's really helpful where we share best practices. We have leaders and capabilities that can ask each other, hey, how did you do this in this engagement? So again, it's the heart of what we do, and it's the foundation which has driven our productivity.
Great. And then a two-part question around Europe. Watts had an excellent end to the fiscal year, but you did note weakness in Europe. Can you walk through, I guess, the heat pump headwind, how much longer that continues? But also you made an announcement around restructuring in some of the manufacturing in Europe, maybe the long-term goals for margins across that business and how that business may differ from the US.
Yeah, so I'll start on this and Shashank fill in some of the details. Look at Europe. First of all, given the war and all the funding that's going on, the new construction part of that business has been down significantly. And in particular, we were a big provider of heat pump manifolds and various products that were, that we sell to OEM residential boiler manufacturers. And at the start of inside of 2023, when the war started, there was a large incentives put in place to sell those products, and we were growing, very strong, and our OEM boiler manufacturers, our customers, were ordering a lot of inventory. Well, what happened is they overdeveloped. Some of these incentives went away because some of the energy concerns that they had subsided. So what happened is there was just difficulty in that market. So we believe there's overstock that handled in 2024. We were down double digits in Europe, primarily driven by between that and the low new construction that was going on. We feel that destocking is going to continue through the first half of this year in the heat pump market. And certainly we believe new construction is still going to be difficult. So we're projecting that Europe is still going to be down -8% to -2% for 2025, given those backdrops. But certainly, our goal is to turn that business around. We focused on, I'll let Shashank talk about the restructuring that we've done in our France location regarding the margins. So Shashank?
Yeah, so we actually did some headcount restructuring in November, December, and then we talked about the one reduction in footprint in France. Just from a historical perspective, in 2022, we closed one of our plants in France. So this is another closure of another plant in France that should complete by the end of this year, and we'll realize full run rate savings by next year. The payback is long, typically is long in France, longer than any other country, but that'll help long-term to drive footprint optimization in Europe. And we'll continue to look at our footprint in Europe, depending on how volumes, what the volumes are going forward.
Great. And Watts has a very strong track record across M&A and extending the portfolio into adjacencies. You've recently added front-of-the-wall products with Bradley last year, and now even a niche category with the acquisition of Icon. Can you walk through the portfolios of these businesses and how they may differ in terms of products and what you're adding?
Yeah, so certainly Bradley and recently Icon get us in front of the wall. We've been traditionally behind the wall, and this gave us an opportunity to get in front of the wall, which really opened up our overall market capabilities. And that part of the market is very fragmented, a lot of privately held companies in that area. So it's an opportunity for us to continue. And Icon was another great acquisition off the balance of that. Certainly Bradley was foundational, large, highly recognized leader in its markets. And Icon is there also, right? In correctional facilities, a unique niche, and they provide controls and capabilities inside of prisons, as well as, products in front of the wall inside each one of the cells. So it's unique, very profitable, and something that's growing, and it opens up our aperture to continue to expand in the front of the wall applications.
Can you describe a little bit more what's attractive about front of the wall compared to your behind-the-wall products? Is there a difference in distribution or sales process?
So a lot of it is some similar distribution. A lot of our existing reps had Bradley as a product line, so it's leveraging some of our current reps. And as I said, it's fragmented. In a lot of privately held company, it's ripe for consolidation. So when you look at it, I use Bradley as a great example of our smart and connected initiatives. What we've learned in smart and connected, it's very expensive to do smart and connected, you know, properly, right? You have security, you have controls, and scale makes a difference. Bradley's a great example where they knew they needed to get into smart and connected, and leveraging a partner like us that has the capabilities we have is a great answer. And they knew it was going to be very expensive if they started and did it on our own. So that was a great new addition, allows us to do that. And Icon is a leader in smart and connected products, because in prisons they control the water usage both in toilets, sinks, and showers, right? And they've led the market in the controls of that. So those are examples of why, it's an opportunity in those markets, and something that we believe, where it makes sense, we'll continue to expand and look for opportunities, not only in North America, outside of North America. Our acquisition in Australia with NWare, that also had front of the wall as well as correctional facility capabilities. So the two, Icon and Bradley, actually are leveraged in our Australian market, and it allows us to bring some of our capabilities through our international markets.
Maybe just more generally, can you review the strategic and financial criteria you look for in an M&A, from an M&A perspective?
Yeah,
Sure. Go ahead, Shane.
So typically what we look for is year one of acquisition to be either EPS neutral or EPS additive. And then by year 5, we want to make sure that the EBITDA margins are additive by year 5. And then also by year 5, the ROIC is greater than our, which is about 10%. And obviously those are the financial criteria beyond the strategic fits that Bob talked about.
Yeah, and strategic, just to re-emphasize that. Look, it's got to be core or complementary to what we do. We want to have brand names, market leadership, usually 1, 2, or 3 in their markets, and allows us to expand geographically, including leveraging the technology like I talked about in our smart and connected. And certainly, if we can service existing customers, that's always helpful. So again, those are some of the strategic and, as Shashank said, financial criteria we use.
Great. And the likely size of deals, I guess, Bob, what's your sweet spot? And maybe with that, your balance sheet is in pristine position at this point, but what's the leverage ratio you're comfortable operating at?
Well, we look at small, medium, and large, and we're always looking at. So I don't believe we would ever go over like 3.5 times for the right acquisition. But I think our sweet spot is exactly what we've been doing with Bradley, NWare, Icon, nice small to medium bolt-ons inside of our organization, and stuff that we, look at. And as you said, our balance sheet is pristine. We continue to leverage and look for opportunities, and our pipeline is strong, and we'll continue to be disciplined as we look at M&A opportunities.
Great. And with that, in the absence of M&A, maybe if you could review your capital allocation priorities.
Yeah, go ahead, Shashank. You want to grab that?
Yeah, look, so we do focus, excluding M&A, we do focus on, as I talked about, to drive productivity, automation in the factories, right? So heavy CapEx, automation in the factories, R&D, Bob talked about Nexa, right? So that was significant, both CapEx and OpEx. And a lot of that showed up in the R&D side. So that's another area. Again, so it's driven around productivity. On the share buyback and stuff, it's limited to offset dilution for the most part. And then dividend, we do believe in paying a fair dividend within the water space. And on that point, we've increased dividends about 20% over the last couple of years.
And then tariffs as a hot topic. You did note that you usually produce where you're selling, but any implications to your business on the potential of tariffs?
Yeah, well, certainly we watch and monitor that like every person is doing right now. But as you said, we believe in manufacturing close to our customers. In the US, we're very vertically integrated with a state-of-the-art foundry in North America and machine shopping capabilities. But we do purchase product from China, Canada, Mexico, as well as your previous speaker talked about our sub-suppliers, which we do have a stronger handle on understanding what they do. So we watch this, we monitor this, and as I said during our last earnings call, we're not afraid to pass on cost to our customers. So certainly, as we see tariffs, we'll be implementing price increases to our customers to partially offset that, as well as, we continue to leverage our global supply chain capabilities to move and to where it makes strategic sense, and we have multiple sourcing capabilities around the world. So again, we're focused on this as much as we can at this point in time, but we're going to stay proactive and monitoring this very, very seriously. And as many companies, plan A, B, and C, we have to have given the current uncertainty right now.
Absolutely. And then you did mention during your presentation data centers. So if we take a near-term view, obviously it's higher energy, higher water use. How are your products integrated into a data center? And perhaps what's the revenue opportunity at a data center versus a conventional, commercial building?
Well, a data center, as you can imagine, is moving a lot of water to cool things down. So, from a commercial building point of view, it certainly it has all of our products, right? It has backflows and everything else, but there's tons of valves inside of the cooling system. So it's per building. It's certainly one of our highest our highest application of our product. So it's more than a regular commercial building just because of the number of valves that are keeping the processors cool. So it's an opportunity from us. It's something where we started in China several years ago. We're a leader now in China, and we have growing presence in both North America as well as Europe. And it went from basically nothing to about 2% of our sales and growing double digits for us. So exciting opportunity, leveraging our capability, our quality products, and our overall global supply chain.
And then perhaps my last question, you also mentioned technology and just changing building codes and how they've evolved. What's the impact on your business and in terms of new products, R&D issues you have to address?
Yeah, well, certainly, we're on many codes and standard capabilities. Watts was actually, invented codes for the plumbing system. So we're active, we're leveraging our knowledge and capabilities and quality of our products. And most importantly, it's safety, right? It's safety. How do we protect our water, given it's a precious resource, et cetera? So I think it also allows us to differentiate our products with the reliability. Plumbers don't like to change products that they trust and rely upon because they know it works. So again, we continue to drive codes, being on the bodies and making sure our water systems stay safe.
Well, thank you both, Bob and Shashank, for joining us virtually this morning, and we look forward to having you back next year.
All right. Thank you. Take care.
This podcast is an excerpt from Gabelli Fund's 35th Annual Pump, Valve and Water Systems Symposium. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of December 31st, 2024, affiliates of GAMCO Investors Incorporated beneficially owned 5.1% of Gorman Rep, 3.3% of Graham Corp, 2.65% of Enpro, 2.44% of Watts Water Technologies, 2.41% of Mueller Water Products, 2.05% of Flowserve Corporation, and less than 1% of all other companies mentioned. One of our affiliates serves as an investment advisor to Crane Company or an affiliated entity and has received compensation within the past 12 months for these non-investment banking securities-related services. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI or 800-422-3554-914, 921-5100 fax, 914-921-5118 info@gabelli.com.